Welcome back to Chicago Future of Finance, live from Hood Summit in Las Vegas. Let's continue the conversation with the SIBO folks. We've got a great pair with us here on the couch in Hood Summit, bringing together lots of different backgrounds from different parts of Wall Street and finance. Mandy Zhu is to my left, head of derivatives market intelligence at SIBO. And next to her is Stacey Gilbert, senior director at the Options Institute. This is fun because we were just talking, like, we all know people from different parts of our career. You guys were also Wall Street prior to SIBO. You were at Credit Suisse, Mandy and Stacey. You were both on the buy side at Glenmead prior to this, and then you were at Susquehanna Group for 20 years. Yeah. This is also your first interview since joining SIBO. So
it is. I had to come back. I had to have my first interview with you here. It's great.
I love that. Tell me about the location and what it means to you, because I think in what Chicago Future Finance, the show is about, we said from day one, there's a kind of blurring line between retail and institutional. Retail Hood, obviously, traditionally, but there's a lot of institutional people like yourself now right in the middle of it.
Yeah, it's incredible. Just looking at the journey of the options landscape over the years. I was joking with Mandy last night that when I started my career, I was on a trading floor, which zero DTEs, believe it or not, existed then. But since there were only monthly options, I only got 12 opportunities to trade zero DTEs. Everything was tickets. There were 4 exchanges. There were fractions. I mean, it was a very different environment, and it was much more difficult to trade. The access wasn't there. Fast forward, now we are 28 years later, and you just look around the Hood Summit, and it is incredible to see the growth of not only the type of investor that's out there, but the products that are offered, the way that investors can interact. And from my perspective, which is why I'm part of the Options Institute, is the education that is now accessible so that everybody can take control of they can actually own their own decision-making when it comes to their investment objectives.
It's a big part of it. I love that too. Education, I also feel, I know SIBO's got people everywhere, but Chicago is kind of home base for a lot of these themes and education that came from a lot of the brokerages and from the financial institutions like SIBO. Stacey, to follow up on the point real quick is, do you feel that some of the institutional things that maybe were super exclusive 20 years ago, now people just kind of talk about and use casually?
Oh, it's amazing. I mean, just think about just the growth of the S&P 500, the SPX option space. That typically was an institutional type of product. When I was actually at an institution, we used to talk about the SPX options as where liquidity goes to concentrate. We knew that as markets got more turmoil, there would be liquidity within those option space. Now that's accessible to investors that are not considered institutional, but have an institutional knowledge, again, because of some of the education that's provided. So the opportunities that existed 20 years ago are now actually available to investors who are getting that understanding, or understanding how to define their risk, and are getting access to the most liquid options market there is in the world.
Mandy, you've been right in the middle of this for a couple of years now. And in fact, when I might have mentioned this first time interview when you were at SIBO, my previous job, but I read your research when I was at Bloomberg, and it was top of the class and everybody knew that. And one of the first few times I started to read it was, boy, this is going to be an undertaking for me. And as I learned options, and then you came to SIBO, what is your kind of read on the level of sophistication for the way people are using these products? Because, from the reporter side, you put out one of the most sophisticated products.
Oh, thank you. But I to kind of add on to Stacey's point, the sophistication of retail, that's been something that's very surprising to me. And it's really encouraging to see. I think it's really directly off the back of a lot of the education efforts that we and others have kind of put forth. But especially, if we'll look at like zero DTE options, if we look at the way that retail trades versus the way that institutional traders trade, the type of strategies that they deploy, it's actually very similar. So it's not that institutions are, deploying some very sophisticated strategies. Both groups, about half the trading in simple put call single legs, half the trading in multi-leg strategies, spreads, condors, butterflies, straddle strangles. Almost zero difference between the two. Exactly. Right. So I think that increasing sophistication, we see it in our products, and we see it just from talking to the investors and traders here at the Hood Summit.
The point of it all kind of being the same plane, all those different types of options trades. Mm-hmm. We've been talking a lot about the advisor side. Do you feel that the individual trader has the size and the edge now to kind of force understanding and education, even at, say, an advisor level? Because it seems like that's where a lot of this adoption now also intersect.
Yeah, the growth of retail, I think it's coming in two different fronts, right? So obviously there's the self-directed trader, and that's a lot of them are here at the Hood Summit and Robinhood customers. But actually a big part of that growth is through option-based ETFs and other wrappers that make option strategies even more accessible to the end user, to the end investor, right? Because when we talk to our investment advisors, a big part of kind of the hurdle to getting their end clients to adopt options is actually explaining what's a call, what's a put, right? And what's delta, what's gamma. A lot of times that goes over people's head. But now with these ETFs, right, all you need to look at is the performance. You kind of simplify the conversation away from option Greeks to look at the performance of the strategy when market sells off. You know, does it have less downside? Does it still capture most of the upside? Now you're talking about risk rewards. You shifted the conversation. I think that's why these, ETFs have really kind of exploded in popularity in recent years. It's making the option strategies even more accessible to retail.
And I think that's kind of when it circles back to institutional a little bit, Stacey, where I wonder with your background from the buy side, what do you kind of see as being the most demand, what they need, and how can then kind of Siebel kind of serve those needs, and where's that edge that people see in this market basically that they want?
Right. I mean, the way I've always thought about options for the last 28 years is there are two driving principles of why you would trade options. One is income and the other is protection. So the vast majority, as to Mandy's point, of the products that have come to market, whether an investor chooses to trade options themselves versus actually having it through an ETF wrapper where you're having somebody else actually trade the options, it's the understanding of what are the driving forces. Well, I want a product that's going to give me income, or I want a product that's going to protect me. We think about it from an asset allocation perspective. You have an asset allocation. What is the goal of asset allocation? It's to actually have perform well through multiple market segments here. And part of this protection aspect, which I think has been a huge growth of some of these products, is when the market does sell off, I want something that I can look at and say, okay, I'm okay. I don't need to panic sell. I've got this thing. This has worked. It's done what I've asked it to do. And then through other various cycles of the market, I want the income. I want to make sure that I have something where I feel like I'm being paid to be compensated for some of this risk. So again, that hasn't changed over the years. It's just the accessibility to actually have income and protection to clients in various formats that's changed over the years.
When you think about how some of these funds use options and to generate income, and they can right now basically look at the status of the options market and they can say, all right, for this volatile company, say a Palantir, a MicroStrategy, or a Bitcoin, looking at these particularly volatile stocks and pulling income from that, basically they can say, all right, well, based on the option structure right now, we can predict this is going to lend us or yield us rather something around 30, 40, 50% a year. How do you feel about taking those strategies and kind of pitching them like that when you hear those types of arguments? Because then people can say, all right, well, the underlying may change or something may shift, but these are really big products now that pull income and yield from volatile underlying stocks. I'm curious what you think about those, Stacey.
Yeah, so I think the most important thing for any product is you have to get investor buy-in from the start, right? So it's wonderful to have a headline, hey, you're going to get 30 or 40% yield. But what is actually giving you that 30 to 40% yield? It's you are likely giving up upside, and you are owning a stock that has a lot more volatility and could see more downside than that 30 or 40% yield. As long as the investor education is there to understand what the product is offering and understand the risk reward, it's not a free 30 to 40% yield. There is a return for that yield, and that is the potential upside participation or ownership of a stock that you may not have that downside protection because you're so focused on the yield. Again, I'm not here to tell everybody what is the right choice for them. I'm here to educate them with, you tell me what you're looking for, and these are the various products that may offer what you think is appropriate for your investment.
That's the advisor role right there.
That is the advisor role. Exactly.
Comes in and says, okay, what are your goals? Because some people do, and that's kind of what I was talking a little bit about yesterday with Rob Baldwin at PMR is, how do you take people who are used to slinging options that maybe kind of go for those juicier trades to say, hey, you don't have to invest like a grandpa now, but maybe put that in an ETF that will, generate income and do kind of similar to what you're doing, but maybe lower volatilities. I think somewhere in that conversation, Mandy, is the zero DTE stuff, because in the similar way, there's a lot of people who look at that and they go, all right, because of this just immediate decay, I can get something that can change immediately fast. And I can have a one big hitter on a day. It's like me going on the poker table and saying, I'm going to put it on, I'm going to wait till I got a good spot. I see, I'm going to, hover, try and wait, and then boom, put a lot on there. But then there's an institutional side that's doing everything almost inverse to that, which is just seeing a more full volatility surface, right?
So I think what's interesting about the zero DTE space in particular is that it's actually very distinct from the other parts of S&P options market. So if you look at like non-zero DTE options in S&P, most people use it for hedging purposes.
Right.
That's why you typically more puts trade than calls. Typically puts are more expensive than calls. If you look at zero DTE options in S&P, put call ratio has been consistently 1. So people are actually, there's not one dominant use case in zero DTE options is basically the point of this. There are people who are using it for directional bets. It's like a cheap lottery ticket, right? Like I think the market's going to go up this much today. I'm going to buy a very cheap, nominally very cheap option that can give me a 100 times, 50 times payout if I'm right. But there are also other people who are selling these options, most typically in spreads, that are saying, actually, I don't think the market's going to move that much at all. And I'm happy to clip that coupon and get more coupon by doing it in zero DTE. The fact that we have that diversity of use cases, we have that diversity of investor bases. About half the trading in zero DTE comes from what we think are retail investors and half from larger institutional investors. But it's very balanced between the two. I think that's what makes it such a great or a unique ecosystem, is that there's not one dominant use case. And that's what makes, I think, the liquidity in this product and the growth in this product so fascinating.
There's a lot of people when they hear stats like, 70% of volume last week, whatever was zero DTEs, they go, oh. And I get that maybe that presents, unique, but maybe not worse outcomes, because I would think they still been to better outcomes, because ultimately the number of expiries you have, your shape, your vol curve gets smoother, right? But then in theory, it's like, okay, then how tight could we make those expiries? If somebody is willing to take something on that just decays immediately, does that concept go to infinity, or where does it kind of like stop?
Yes, I don't think there's necessarily like an ideal percentage of zero DTE. Like, I don't think people need to be concerned that zero DTE is now 60% of SPX because of the fact that it's very balanced. Yeah. I think initially when zero DTE options first really started to explode, there were a lot of concerns around kind of the market impact of these options because of the kind of the hedging involved, the underlying hedging. But what we've shown again and again in the data that we see is that because it's very balanced between buys and sells, between different use cases, the actual hedging from these products is very minimal. Like on average, is 0.1% of overall S&P daily liquidity. But also we've heard from market makers that because of liquidity in zero DTE options, they're actually able to offer better liquidity further out, because they have
100%
easier way, more liquid way of hedging their risk that allows them to extend risk further out. If someone wants to trade a 6-month, 1-year option in S&P, they're not actually getting better liquidity because of the growth in the front end of the curve. So it's not a zero-sum game. It's not zero DTEs taking away liquidity from other parts of the curve. It's actually all additive.
Kind of filling it in wherever there might have been leaks. Yeah. I wonder, Stacey, to kind of put it all, to some extent, into what also is happening here. We're at all-time highs in the stock market. We continue to grind. I wonder if this kind of improved liquidity and the fact that most of those trades, right, that people are betting on for big moves don't happen. Most of them, we just continue to kind of grind. Is there a connection back into the market in some way?
Well, so one of the things I think Mandy brings up that's really important is the way that these trades are happening. A lot of them are defined, right? They are trading through spread. So I think this is incredibly important when we think about volatility, the impact of what this is doing to daily volatility. We're looking at spreads which are very defined risks. That impact is fairly minimal here. So in terms of thinking about how this looks for the market, is this why the market is at all-time highs? No, it's not. I mean, if nothing, April will show you that the market will respond to news that is out there, and it will correct for new information at all times, which I think is actually the really important point here. Again, I'm going to go back to the investor education point.
That's an important myth to kind of bust, by the way. Because a lot of people who think that this is all designed, with a directional bias in mind, but that's not because of the tools. That's because of just what people do, right? Stocks generally go up.
Exactly. I mean, markets are up basically 70% of the time here. And the other thing to keep in mind is like volatility. If you think about the volatility risk premia, it exists. It's basically 85% of the time. Implied volatility is higher than realized volatility. There are reasons that these spread trades are popular. There's historical evidence. And again, I think this goes back to that investor education it's not, let me just buy an option, cross my fingers, and I have a lottery ticket here. It's a much more informed environment out there where the trades that are being done are actually trades that are very sophisticated. And again, that sophistication has come with education, which again, that's why I joined the Options Institute, because I think it's incredibly important.
And there's some sophisticated trades happening here for sure, as I've talked to people. But then it's also, sometimes you do want to punch a lotto ticket, but that's up to you.
Just understand the risks with it, right?
Exactly. Stacey Gilbert, Mandy, really fun conversation, really great perspective. Love to hear kind of the way Wall Street kind of meets Main Street in some ways and options and basically math kind of being right in the middle. You guys are really great on the logic and the math for options. Great team there.